In this episode, you will be familiar with the bonds and different types of bonds in financial markets. Welcome to Godin Early, a podcast about investing in financial markets such as cryptocurrency, the forex market, and the stock market. Here is your host Komal from Ados Capital, and don't forget that
Ados is with you to succeed in investing.
So what is bond? A bond is a document that pays the holder a fixed amount for a fixed period in accordance with the law. In fact, bonds are a form of government debt. The investor on the bond is the lender and the issuer is the borrower. The issuer borrows a bond from investors to receive a fixed interest rate over a period of time. Some of these bonds are paid interest at the nominal value or principal of the capital twice a year, which is called interest or coupons on these bonds. And for this reason, other bonds are called fixed income bonds. Interest rates on bonds. Long-term bonds have a higher interest rate as a return on investment because of the risk that interest rates will increase before the maturity of the bonds, which is known as interest rate risk. The quality and creditworthiness of a bond depends on the ability and willingness to pay the principal. What are different kinds of bond issuer? Bonds issuers are generally divided into three categories: treasury bonds issued by the federal government, municipal bonds issued by local and state governments, corporate bonds issued by businesses and corporations. What are different types of U.S. Treasury bonds? Treasury bills. Due to their short maturity, these bonds are called short-term Treasury bonds. These bonds are a U.S. government debt document that matures in less than a year. Medium-term Treasury bonds. The maturity of these bonds is between 2 and 10 years from their issuance. Long-term Treasury bonds. The maturity of these bonds is between 10 and 30 years. That is why they are called long-term bonds. Treasury inflation-protected securities. In fact, the interest paid on these documents is just to cover inflation and price increases at the general level. The basis for increasing this interest rate is the Consumer Price Index or CPI. The main purpose of the U.S. issuance of these bonds is to finance the budget deficit in the government's debts. Federal bonds and monetary policies. The Federal Reserve buys bonds with the banks to control inflation and reduce liquidity in society. In expansionary policies, central banks buy bonds to get out of recession, which expands money supply and lending capacity. At the end, by listening to this podcast, we at Ados Capital hope you have to find the answer of the question, what is bond in financial markets? Also, you can help our progress by sharing this episode, which is published in Ados Investment Magazine, and help to optimize this podcast by submitting your comments. Thank you. Have a good time.
Ados is with you to succeed in investing.